Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about building a conservative portfolio. This website, this application you're looking at is M1 Finance. It's going to be the website I'm using for this just because it's very easy to create your own holdings essentially for your preferred portfolio. So we're going to be creating a conservative portfolio. Now conservative can mean different things, right? Crypto conservative means, Bitcoin, Ethereum, and stable coins almost, like the main projects. Or crypto aggressive could be, random altcoins you never heard of. But we're talking general, old age, stock market conservative, right? So you're not going to be dealing too much with tech or IPOs. It's mostly going to be about conserving your dollars rather than risking it. So let's look into what a conservative portfolio would look like. So we're looking at the S&P 500. Let's add that to our basket. Then we're also doing the growth index by Vanguard, and then finally the dividend index by Vanguard. So let's add this to our pie. So basically what you get is the everyday S&P 500 ETF, as well as the Vanguard Information Technology ETF and the Vanguard High Dividend Yield ETF. Now let's look at these actually in trading view. Let's look at their chart. Let's compare these. So let's get SPY as the one we're comparing with VGT, Information Tech, and VYM, High Dividend Yield. So what you get is essentially the S&P 500 is the balance of the three, right? Over the last, it seems 22 years, of course, Information Tech has outperformed, right? But, past performance is not an indicator of future results. We cannot depend on Information Tech to continue to outperform. But this also brings that you could see just from the pre-COVID crash, right? February 2020, we're looking at the dividend index has only grown about 20% since, right? SP 500 has grown about 35. Looking at Information Tech, and it's nearly grown 58.2%, right? So that's the kind of trade-off. You're trading off, potential returns for risk aversion, right? You're not risking as much dollars with the tech index than you are with the dividend index. Now let's look at VGT specifically, and you can see just in this last, correction that we've had, it fell 18.8% at its worst in 4 days, right? So it fell 18.8% in 4 days. Looking at VYM, looking at minus 7.8, so you're saving 11% essentially by investing in VYM rather than VGT. Now you could see just the difference between these two, right? We've already checked it at the very bottom compared to now. The dividend index is up 90%, right? Let's check VGT. And you're up 139, right? So you're missing out on nearly 40%, almost actually 50% in that scenario. But this is why you have the index in there as well as these three are all combined, right? You're not just getting dividends or tech. If you're conservative, you want a combination of all three. Of course, the SP 500 basically gives that to you already. But just knowing that you have specifically funds for dividends and for tech makes it a little easier because you can see how it balances out over time, right? If you put a third into each, and within 5 years, you have 50% in tech, 30% in SP 500, and 20% dividends, just because based on how it grew then you know that tech has still outperformed and is continuing to outperform, and that's where your money's at, 50% um, in tech specifically. And with M1 Finances, there's a cool feature where you could rebalance, right? So let's say we're at 34, 33, and 33 um, per holding. And within 5 years, tech is, 70%, or what I was talking about earlier, 50% of our portfolio. Maybe you think that's too much. You could rebalance it. It sells it down to 33%. It buys more high dividend yield because that's less. And let's say the SP 500 just stays at 34%. So it balances out and makes it easy for you to continue with your wanted holdings rather than just relying on the super outweighted holding in your portfolio. This is M1 Finance. Once again, very easy and free website to use. Um, and it's pretty dang solid just for that type of investing where it's not active. You don't have to buy and sell on the same day. It's more like you buy and sell in 5 or 10 years, right? Or you just don't sell, hold on to it, and that's your retirement. So I hope this video helped. This is the conservative portfolio. Maybe you're risking too much money. Um, maybe invest a couple $100 a month into this and just set it aside. Forget about it. Don't open it. Forget the password. Forget the email. Um, because eventually it will turn into real uh, not damaging, more like eventful money, right? Maybe $100 isn't very much, but 1,000 or 10,000 is. So I hope that makes sense. I hope that helps you in some capacity. If it did, please drop a like and comment on what we could do better for this channel. Thank you for watching, and we'll see you next time.